Do you agree with the conclusion of the Financial Crisis Inquiry Commission that in the years leading up to the crisis compensation and bonus practices at big banks that too often rewarded short-term gains, big bets, and encouraged senior executives to greenlight irresponsible risk-taking?
Yes, I don't have in my immediate short-term memory all of the reasoning behind that, but I agree with that statement. Okay. I do.
In a speech last month, the New York Fed President Dudley said, quote, "An effective regulatory regime and comprehensive supervision are not sufficient. We also need to focus on the incentives facing banks and their employees. After all, misaligned incentives contributed greatly to the financial crisis and continue to affect bank conduct and behavior. Most recently, we saw this very problem exposed at Wells Fargo. The former CEO and the head of the community bank division were raking in bonuses while their employees were churning out millions of unauthorized accounts. Section 956 of Dodd-Frank requires bank regulators to prohibit incentive-based compensation practices that reward senior executives for irresponsible risk-taking. Regulators issued a proposal in May of 2016, but nearly 2 years later, nothing has been finalized. In the meantime, Wall Street bonuses jumped 17% in 2017 to an estimated $184,220,000, the most since 2006. When you were asked about this rulemaking in January, you said, quote, "I don't have any updates on that for you. It's not something that I have talked to the other regulators about yet," close quote. So today I'm asking you, how is it that you have had time to revisit capital rules, revisit leverage rules, revisit the Volcker rule, all of which were finalized after years of deliberation, public comments, and input from other regulators, and you have not had time to finish the incentive-based compensation rulemaking for the first time?
That is something that is on the agenda, but it is not something that I have a time frame for you on.